But first, with the latest business and market news, over to Jane Edwards.
Thanks, Alan. Wall Street showed some resilience on Friday as investors digested the implications of the massive earthquake and tsunami in Japan, the world's third largest economy. Each of the indices closed the day around 0.5% higher, with gains in stocks that are likely to help supply rebuilding efforts. Shares in Japanese-based companies, including Toyota and Sony, were sold off on Wall Street, while the prices of metals and oil also fell. Forex markets went in the opposite direction, with a sharp rise in the yen amid expectations that significant chunks of Japan's currency will be needed for insurance payouts and rebuilding at home. Across in Europe, the major reinsurers were hammered, falling between 4% and 7% on Friday as the full impact of the disaster was still emerging. The earthquake hit at the end of a week which had already put equity markets firmly in the red. As unrest continued in the Middle East and North Africa, China showed evidence of a slowdown and the focus came back onto European debt. Overall, the US had the strongest share market, while the Nikkei finished 4% lower, 2% of it on Friday, and our local markets slumped. To tell us why, here's Marcus Padley.
Well, as of this week, the glass is officially half empty. The market's been up 18% since the bottom of the market in May last year, and we've lost about a third of that in less than 2 weeks. Most of the falls this week came in the resources sector, as the Chinese growth story was questioned for the first time probably since the first or second quarter of 2009, as the Chinese downgraded their 5-year GDP forecast, reported a scary trade deficit in February, and also we saw iron ore imports down 29% in a month. That pretty much did for the iron ore sector, and that's before we start worrying about Europe, the Middle East, no-fly zones and all that sort of stuff. Also, the currency was down this week, and that's very scary for international institutions who lose money not just on share prices, but also on the currency, and that tends to make them a bit sensitive, causing a shoot first, ask questions later policy, and that seems to be what they were doing. BHP were next dividend this week as well. That didn't help their performance much. A couple of stocks going up there in the resources sector. Extract Resources on talk of a Chinese bid, and also Riversdale Mining as Rio upped the terms of their bid. In other stories, we saw 10 Network sue the 7 Network for poaching one of their employees as their CEO. AXA traded for the last time. It's now become AMP. Amcor settled a class action, also had quite a successful Eurobond issue. We saw Salmat down on a profits warning as Telstra pulled a call centre contract. Car sales did remarkably well this week, considering 49.1% of the company was placed by private equity early in the week. And Equinox fell. They had some quite good results, but everyone's worrying about their big Canadian acquisition, which some people think is happening at the top of the cycle. Finally, the Ombudsman Service has suggested that anyone wanting to trade CFDs should perhaps get a certificate from their accountant or financial planner saying that they're competent to do so. Winner of the week this week was Extract Resources, up 12% on talk of a bid from the Chinese, who have bid for their largest shareholder. And loser of the week is the iron ore sector, led by Fortescue Metals, down 11% after the Chinese iron ore import scare.